Hi, my name's Kelly Eckold. I'm the new Chief Economist here at Westpac New Zealand. I've been living in Washington DC for the last 11 and a half years working for the International Monetary Fund, and I'm really relishing reconnecting with New Zealand and adding a strong international perspective to the great work that the Westpac New Zealand economics team already does. Today I'd like to talk about next week's big event, which is the Reserve Bank's OCR review. We anticipate that the Reserve Bank is going to increase interest rates by a further 25 basis points to 5%. This in itself is unlikely to cause very many ripples in markets, but what's going to really matter is what they say about what they are going to do next. You may recall back in February the Reserve Bank indicated that even after this 25 basis point move that they might need to increase interest rates by a further 50 basis points to sustainably restrain inflation pressures. But things really go according to plan, and this is no exception. For one thing, GDP growth for the end of last year came in significantly weaker than the Reserve Bank expected back in February. And that's going to matter a lot for the amount of tightening that they think they need to do for the rest of this year. The other matter, though, is that signs of significant financial sector stress have emerged in the US and Europe and have required strong actions by the authorities there to stabilise financial stability. These actions seem to have had the desired effect in the short term, but the jury is out whether more pronounced financial sector stress may emerge. And if those stresses did emerge, they would have important implications for the strength of growth in foreign economies and the willingness of foreign investors to invest in countries like New Zealand. Financial stability concerns always trump inflation concerns in the short term. And for that reason, we anticipate that the Reserve Bank will take a cautious tone towards what they're likely to do in coming quarters. We think, though, notwithstanding that, they're still likely to indicate a willingness to increase interest rates further if inflation pressures don't sustainably subside. Let's see what happens.